thanks for joining me with my market report. My name is Mike, and if you're new to our channel or our videos, my market report is on mortgage rates. We kind of get into what's impacting mortgage rates on a daily basis, whether it's something from the geopolitical, or something from headline news, or economic counter could be on there. Sometimes it's just a sentiment change in there. Sometimes like good news could be bad news and vice versa. And if you're on the sideline, you just may not know or understand why this is acting the way it is. So we're here to kind of go over that for you folks. That way, you got a better understanding of what's going on with the markets, and hopefully, if you're following it, if you're like, for example, in real estate, you might be looking just to try to follow and understand what's going on here and why our mortgage rates are doing what they're doing. If you're looking to buy or refinance, you might be kind of following rates to see what's going on and whether to lock in or kind of hold or whatnot, kind of see where rates are at. So, a little bit about myself is I am a loan officer. I do work with a national lender, so we do loans in all 50 states. So, if you guys got anything out there for us, whether it's to buy a home and get pre-approved, or if you're looking to refinance, we can certainly help you with those facets. But if you guys just got some questions out there or questions out there in regards to mortgage rates or whether it's maybe about programs available out there, please feel free to hit us up. We're here to help you guys out as well. We just like to be able to help you guys and make sure you guys are taken care of. Um, so without further ado, we'll start off with the economic calendar, which we don't really have anything today. Most things with a short week. If you're not aware, the markets will be closed on Friday. However, they'll close about half day on Thursday. But so most of the data that's going to be released will be coming out tomorrow. We'll get the final revision for the third quarter GDP out tomorrow. We got existing homes coming in tomorrow. So those will be two of the more important ones for this week that'll be coming out. Today we just got kind of a more or less a slow day today. Headline news for the most part is they're kind of realizing that the stock market's been down the last couple of days, and they're kind of realizing that maybe they were over exaggerating on their concerns over the Omicron virus. They're it's not so much about the variant itself; they're just concerned the reaction. If there's going to be a bunch of lockdowns and people are going to get scared and maybe not travel or spend money, things that would kind of affect the economy in a negative manner. And right now, they're not seeing a whole lot of pullback on the holiday travels right now. It's down, but it's not like horrible right now. It's still doing pretty decently for the most part. And right now, they're kind of coming back a little bit as a result of that. And for the last few days, we've been kind of the mortgage-backed securities been kind of following the stocks as well. So what's been happening is when the stock market's been going down, a lot of that money as a flight to safety kind of goes into mortgage-backed securities or stocks because they are bonds because it's kind of a flight to safety, they're kind of a safekeeping on there. And as a result, sometimes when the money goes back, we'll get adversely affected and go the opposite, where stocks go up and bonds will go, or mortgage-backed securities go down, which brings up interest rates. So to show you or illustrate it, here's where we are today. We are down about 19 basis points currently from where we left off yesterday. Yesterday we basically were at zero, so it was like no change. We started the day higher and it came down and closed at zero or unchanged levels yesterday. Today we're down about 19 so far, so rates will be coming in a little bit worse so far today. So mortgage rates will be adversely affected. And the reason being is that now stocks are up today, and so money's coming out of the mortgage-backed securities, kind of going back into the stock market and helping them out now where they are. And part of this, of course, the old adage or sage advice is buy on the dip. So when the stock market's been taking a bit of a beating the last few days, you got investors who want to buy on the dip. This week could be a little volatile two ways. Your big traders, for the most part, will be out, so there won't be a lot of liquidity in the markets. But you're going to have smaller investors that could move markets. You might get these little knee-jerk reactions that may not make sense, and that's partially the reason out there is the big hedge funds are out there. They don't really absorb that, so you're going to see a little bit more different swings that you typically kind of see on these holiday times because the fewer people on at least the bigger players are out of the market. So for the most part, enjoying the holiday season here. Here's what it looks like today. As you saw, we kind of went upwards and then kind of stayed there for a little bit. And then last few hours, since just after 7, we've been working our way downwards. right now we're at our lowest level we've been for the day so far. And let's take a look at yields. Yields been kind of going the inverse way. Been kind of going upwards. We've opened the day up above the 100-day moving average. Now we're working our way above the technical level and towards the 25-day moving average. Right now we're just sitting under 1.49 right now. And this is just after yesterday where we started operating around 138. So right now we're up about 10 points from where yesterday's open so far. All right, so that's pretty much about it. There's really, again, just the investors feeling a little bit more comfortable where things are at and taking money out of the bond market, putting it back into the stock market is kind of what's happening here. And we'll take one quick look at the median or basic average rate for conforming limits. 30 years at 3.17 and the 15-year is at 2.53%. So these are average. These do have points built into them. If you guys have been following my videos, you guys know that there's a lot of variables that go into rates, and there's no one size fits all. We'll kind of leave it at that. If you guys got questions about that, please feel free to hit me up or check out a couple of the other videos. But we'll kind of try to keep this short and sweet for the most part. So anyways, if you guys got questions, please reach out. We're here to help you guys out. If you guys like these videos, I'd greatly appreciate if you guys can smash that like button. It helps our channel out, helps, or even share. It helps us out. We greatly appreciate you guys. You guys have a great rest of your day, and thanks for watching. We'll see you guys in tomorrow's video. Bye-bye.